It's a fairly important report because the two previous reports, which have tended to beat market expectations, really sort of bolstered the view that, yes, the Fed will ease back on its monthly bond purchases, maybe at the September FOMC meeting. But of course, I mentioned earlier, there's also these worries about excessive risk-taking, overheated credit markets, for example. And of course, all the commentary from the Fed has actually blown up this carry trade. So a lot of the moves that we've seen, whether it's in commodities or equity markets or bond markets, a repricing of short-term interest rate expectations as well, is all part of this. I actually think that blow-up of the carry trade has probably exhausted itself. We're probably going to see some settling down in markets. But I think that financial stability is important. And I think Bernanke's worst nightmare is a bond market crash or a stock market crash, or both, because effectively they run out of policy ammunition. So that's much more of a nightmare than, let's say, the unemployment rate going up on Friday, for example. He could probably live with that. But I think that my guess is I think Bernanke wants out of QE. Well, I think that they've got the ball rolling. You could argue that may have been clumsily engineered, and a lot of the communications, the commentary that Bernanke used, not in the prepared statements, but as we saw in the congressional testimony, sort of outside of that in the Q&A, likewise at the FOMC meeting 19th of June, it was in the press briefing that this 7% unemployment rate magically appeared out of nowhere. There was no mention of it in the FOMC minutes or any previous speeches. So to some extent, I think that's been a little bit clumsy and gives the impression that they're making it up as they go along, which they might be. But I do think that we'll start to see some easing back in bond purchases at the September meeting.
So it's interesting that you say he wants out. Others say it is still dependent on the data. The Fed's saying it is dependent on where the data goes between now and this timetable that they put forward a couple of weeks ago. So do you it's got to be one or the other, really, hasn't it? Well, it's got to be dependent on the data, or it is just a belief that he has that he needs to be brought to an end.
Well, I think I was just saying to one of your colleagues before we came on air that he can't really come out and say, actually, I'm worried about financial instability. I'm worried that risk-taking has become too excessive.
No, I'm worried about the size of the Fed's balance sheet.
Because all of a sudden the markets would panic, and then we have a self-fulfilling collapse. So he has to make it sort of data-dependent. But if you look at the speeches of the doves on the FOMC, like Bill Dudley, New York Fed president, for example, who spoke last week and is speaking again today, is very much along the lines, well, on the one hand, policy has to remain accommodative, labour market conditions are improving, but we'd like them to a bit more. But, and there's a big but, in the months ahead or later in the year, there may be a case dependent on, if our view of the economy pans out, that we ease back our monthly bond purchase. I think they're going to do it. And there's lots of obscure and esoteric reasons to do with the operation of the repo market, of the money markets, why they need to ensure that by buying US Treasuries they don't actually inadvertently squeeze liquidity.
And what's the number you're going for if we have a little round-the-desk sweepstake?
Well, my crystal ball, which I polished this morning before I came on the show, says 150,000, so slightly below expectations.